Okay, good afternoon and welcome back everyone to our second part of our income series. My name is Tony Zhang. I'm the chief strategist here at Options Play. And today we're here to talk about how to invest for your future using short puts. Now, a couple of weeks ago, I did the session on cover calls, which is by far the number one options trading strategy, the most widely used option strategy by all investors. Today, what we're going to talk about is the most underutilized option strategy by most investors, because almost everyone that's viewing here today probably today does something very similar to what a short put does, but you may not be thinking about short put as an alternative to something that you're doing almost every single month. And because you're not using short puts, you may be missing out on a substantial amount of yield in your portfolio. So today, what we're going to do is spend our time focusing on the short put opportunity, understand what it compares to so that you can see and compare how much yield you might be missing in your current portfolio. So let's go ahead and get started. But before we do, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that I'll be using as example purposes during today's session. So I'm going to kick this off by explaining who this session is for, so that it's very clear as to who might be interested in considering selling puts. Then we'll take a look at what is a short put and helping you understand short puts by using some examples. And then I'm going to show you short put challenges, meaning what type of challenges are you going to face after you sell a short put, and showing you how you can find these real-time opportunities based on your given portfolio. And then we'll talk a little bit about trade management before I open this up for Q&A here at the very end. But the primary thing that I want you to be able to walk away from today's session is a clear understanding as to how can you add anywhere from 5 to 10% monthly yield to your existing portfolio, and by simply purchasing securities that you are interested in purchasing, that's maybe sitting on your watch list, or stocks that you're trying to acquire that you're thinking about buying. How can you add an additional 5 to 10% yield to acquire those stocks? And we're talking about 5 to 10% every single month. So this is a fairly substantial amount of yield that you could be missing out on or giving up by not looking at a strategy such as a short put. Now, before we get started, I do want to first of all welcome everyone for joining us here at Options Play. My name is Tony Zhang. I'm the Chief Strategy Officer, and my goal here with the options education that we are going to host here for Canadian investors is to make sure that not only do you understand the best practices for utilizing these option strategies for your portfolio, but more importantly, that we focus also on helping you get onto the path of profitability, because that's why we're all here. You're learning options, you're learning technical analysis, you're learning fundamentals of investing, because you're hoping to be able to take that skill set and turn it into profits for your portfolio. And that's one of the key things that I'm focused on here, beyond just explaining the mechanics of a short put, but making sure that you understand the bigger picture of how this fits into your portfolio so that you can reach profitability. So for those of you that are joining me for the first time, please type your name, type where you're currently joining from into the chat window, just so we can get a sense for the audience here in the room. And please feel free to chime in at any time if you have any questions along the way. I'll try to address them in real time, but we will have a Q&A session here at the very end. So we'll start off by talking about who is this webinar for. Now, here's the thing. A lot of the times as options traders, we're trading fairly actively. And thank you for those of you that are starting to chime in. Welcome from wherever you are, Ontario or Vancouver. And I know most of you probably are from the East Coast, but plenty of you are from the West Coast. So please chime in, let everyone know where you're from, just so we can feel like a community here. But like I said, with regards to trading options, a lot of the times we talk about trading options fairly actively. So, this is largely kind of your brokerage account. This is typically not your retirement account where you are trading, every single week, every single month. especially with some of the option strategies that you might deploy. And this is useful for when you have a directional view in the market. But for most of you, majority of your wealth is held in longer term investments in equities and ETFs and perhaps other types of mutual funds, bonds, those types of investments that you might have in your retirement portfolio that you just generally have in your longer term portfolio. So what we're here to talk about today, even though what we mostly talk about here is active trading, what we're here to talk about today is really this portion of your portfolio, the longer term investment portion of your portfolio. Because again, most investors keep the majority of their wealth in these longer term investments. And if you purchase securities for this longer term portfolio, you can generate upwards of 5% yield in a single month if you use a few simple rules to help you achieve this consistent income stream, okay? And this is really what we're referring to in terms of short put. So let's first define what a short put is. It's basically selling a short put on a stock or ETF that you want to acquire, meaning this is only a strategy if you want to buy a stock. Do not sell a put on a stock that you do not want to purchase, because when you sell a short put, you have the obligation to buy the stock. Now, when you sell a put, you're going to receive a put premium as yield for the cash that you set aside in order to purchase the securities. And when you sell a put, it creates an obligation to buy the stock or ETF at a specific price. Now, you might be, if this is your first time looking at a put option, or this is your first time looking at a short put, you might be saying to yourself, this sounds like a lot of technical jargon I don't really understand. So let me break this down for you into something else that you might be doing today that has effectively very similar obligations to this legal language that we're talking about, okay? So when you sell a short put, you have to put aside cash to purchase those securities, and then you are obligated to purchase those securities at a specific price. Now, does that sound like something that you do today in your portfolio? If it doesn't, let me remind you of what a buy limit order does. What does a buy limit order do? It allows you to potentially buy a stock or ETF at a specific price. When you place that order, you have to put cash aside in order to place that order. And if the stock hits that specific price, you are obligated to buy the stock at that specific price. Now, does that sound like something that you do today? And the answer is yes. A buy limit order and a short put have virtually similar obligations and legal language in terms of what do you have to do when you enter those orders, whether it's a short put or a buy limit order. Does that make sense, everyone? Please type 1 into the chat window if that makes sense to you. That a buy limit order and a short put have very similar obligations from a legal perspective when you are placing those orders. Now, most people are not thinking of short puts as very similar or identical to a buy limit order, but when you buy stocks, you predominantly use a buy limit order. You probably don't think about short put. The difference between a buy limit order and a short put is that a short put pays you income, and you'd be surprised at how much income you get versus if you were to place a buy limit order. So I'm going to use an example to help drive this home. Let's say you want to buy 100 shares of Shopify at $60. Currently, the stock is trading roughly around $64. Let's say you want to buy at around $60 and you have a target price of 100. So as a stock investor, you place a limit order to buy your stock at $60. That means that you're risking $60 a share, because if that stock gets executed, that order gets executed and the stock drops to zero, your risk is $60. Your potential reward is the difference between your target price and the purchase price that you have, and you have no exposure in Shopify until the limit order hits that specific price. As soon as it hits that price, limit order will get filled, and now you are exposed to the fluctuations of Shopify. That side, the equity investor, I'm presuming that almost everyone watching this today is at least familiar with that. Now let's shift over to the option side. Let's say as an option investor, I also want to buy the stock at $60, but instead of placing that limit order, I'm going to sell a put option. And let's say I go out to the June and I also sell a $60 put option, because that's where I want to buy the price. That's where I want to buy the stock. But a short put in this particular case pays me $3 per share, or $300 per contract. Now, this is what changes the dynamics, because by simply selling this put, because I immediately collect the $3, if this put gets put to me, my risk is reduced from $60 a share down to $57 a share, because I'm collecting $3 a share in income that will offset the cost of purchasing the stock. That also shifts my potential reward, because my cost basis changes from $60 to $57. That increases my potential reward. So am I reducing my risk, increasing my potential reward? And if, let's say, over the next month or so, Shopify does not reach my $60 price target or my entry price, as a limit order investor, like I said, you have no exposure in Shopify. You have nothing to show for the cash. Your cash is set aside to buy the stock. And if it never hits that price, that cash just sits there. But the cash that you put aside in a short put not only pays you $3 in this monthly income between now and June. If that short put, in this particular case, the June $60 put, expires and expires worthless, you can sell another $60 put, or perhaps another price at that point, but you can sell another put and collect more income. So as you are waiting for you to acquire this stock, you can actually generate monthly income, consistent income in your portfolio until the stock reaches the price that you want to purchase the stock at. And now you've purchased the stock at the discount once you include all of the premiums or all of the income that you've received up till that point. Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. Perfect. Now, I do want to make clear that up until now, I've put these two strategies in very similar light, but there are some key differences that are important to understand. First key difference is that for a limit order, you can place a limit order for any number of shares. One share, 1,000 shares, you can put in any number of shares that you would like to buy the number of shares at the limit order. There's no limitations there, other than perhaps fractional shares. But on a short put, you must trade in 100 share increments. That is one of the major limitations of selling short puts. You can put a limit order to buy 10 shares. You cannot sell a short put for 10 shares. The minimum is going to be 100 shares, okay? So you do have to trade in 100 share blocks when you're selling short puts. So if you're looking at a high price stock, you're looking at a stock that's trading at $300, you're going to need $30,000 to set aside to purchase that to sell that short put. So you may have limited flexibility in that short put. Important detail to remember. Second thing to remember is that a limit order, like I said before, basically gets executed and filled as soon as the stock hits that price. But a short put will typically only get assigned to you, meaning where you own the stock, if the stock is below the strike price on expiration. What that means is that it's possible that when the stock is trading at roughly $64 now, that over the next, that $64 now, that let's say in the next couple of weeks, the stock dips to $59, but then a few days later, it jumps back up to 62. And by the time that the options expire in June, that the stock is actually above 60, that at that point, you don't own the stock. You actually just keep the $3 in income and you don't own the stock, versus the limit order investor is now owning the stock and has now full upside in the underlying position. So those are the two primary differences between a limit order and a short put that's important to understand. Does that make sense, everyone? Please type 3 into the chat window if that makes sense to you. Perfect. Okay. I have a chart up here of Shopify. And as you can see, the stock has been largely range bound, slightly trending higher here. It certainly has reached $60 multiple times in the past few weeks that were potential buying opportunities. And maybe you think that this stock can continue to kind of trade sideways, but then slowly grind its way higher, right? This is just for argument's sake. This is just an example. That's not my particular view of this particular stock. I don't necessarily have a view of this stock. I'm just, again, using this as an example purpose. So what I want to do here is a bit of a thought experiment to help you understand, now that you understand the mechanics of the strategy, how can you actually implement this? And in order for you to do that, you need to pick two things. you need to pick an expiration date, and you need to pick a strike price. And I'm going to make this simple for you. We've done a lot of back testing on options expirations on this type of strategy, and we've tested just about every single possible expiration and strike price to get a sense for where do you get the best yield and where do you get the best outcome for this particular strategy. So I'll just flat out tell you that from an expiration perspective, on a short put, the optimal expiration is somewhere between 30 to 45 days. That's just, there's no ifs or buts about that. So let's talk a little bit about strike price, because there's a lot of flexibility here. And there's a lot of various views as to what you might want to use to sell a strike price for a cash secured put. Now, a couple of weeks ago, we talked about covered calls. And we talked about when you're selling covered calls, you want to choose strike prices that are far away from the current price so that you can get the capital appreciation of the stock before it gets called away. And you actually secondarily prioritize income. Capital appreciation is first, income is second. Now let's talk a little bit about short puts, right? The stock's trading at $64. I have a few different choices up here. Let's say you choose a $60 put option. That collects roughly $3.30. If you collect a if you sell the $58 put, that collects about $2.63. If you sell the $56 put, that collects about $2.09. And if you look at the returns here, what you get is the static return, meaning how much yield do you earn between now and the expiration date, and what does that come out to be annualized if you do it over and over again throughout the year. And we only do the annualized number so that you can compare different strategies apples to apples, especially if you're looking at different time frames. But since we're looking at the same time frame, just looking at the raw return should be sufficient. You can see that the 60 strike collects almost above 5%. So you're earning 5% over the next 45 days, 4.75% for the 58s, 3.88% for the 56s. So type your answer into the chat window. Which one of these strike prices would you choose if you were considering selling a put on a stock like Shopify? How much yield do you think you'd like to get? And how much return do you think you're going to be choosing? Andre's chosen 56. I see a couple of 58s. I seem to see a lot more 56 and 58s at the moment. I see a couple of 60s coming in, but predominantly I'd say the answer seems to be the 56 and the 58. So it's interesting, right? Because on the cover calls, we said that it's best to prioritize strike prices that are very far away from the current price of the stock. Now, when we look at short puts, the overwhelming evidence seems to show that when you're selling short puts, you actually want to choose the opposite, strike prices that are close to the current price of the stock. And this provides two potential benefits. One, when you're choosing strike prices that are relatively close to the stock, you have a higher probability of the stock being assigned to you so that you can actually own the stock. Because if you don't own the stock and the stock rallies, then you're never participating on it, right? You're only collecting the $3 roughly or so, but what you're really looking for is the $30, $40 in upside of the underlying stock. And the only way you can ever capture that is if your order gets filled, right? Think about a limit order, right? If you're placing a limit order at $60, that has a relatively higher probability of getting filled. If you place it at $58, it's going to have a lower probability of getting filled. If you have a 56, you're going to have even lower probability of being filled. So when you're selling a short put, what you want to do is prioritize the probability of you owning that stock, and you want that relatively high. So the 40 delta actually tells us the probability of the stock being assigned to you. So when you choose a 40 delta, you have approximately a 40% chance that that order will get filled at expiration. If you're looking at a 56 or a 20 delta, there's only a 20% chance of that happening, meaning 80% of the time you sell a short put, you're not going to end up owning that stock. And remember, you're selling short puts because you want to own the stock. You think the stock is going to rally. And you have the secondary benefit is that the strike prices that are relatively close to the price give you a really nice yield. A 5%, here, almost 6% discount on the purchase of your stock. So if the stock ends up below $60 at that expiration date, you don't own it at $60. You own it at $60 minus the $3.30 that you've collected in premium. So you're really owning this at about $56 and change. You know, that actually means that you're owning it down here even though you just need the stock to be below $60 in order to get it filled, right? So you're getting the probability of getting filled at the $60 level, but you're getting a cost basis at the $56 level. And that is the real difference between why selling a short put has such a large advantage over using a limit order. Does that make sense, everyone? Please type 4 into the chat window if that makes sense to you. Perfect. So now that you kind of understand the value of a short put, how to go about implementing it, let's actually, before we go into challenges, let's look at the Options Play platform, because I want to show you how you can actually take what you've learned right now and actually start applying it to stocks that you want to own. So let's take a look at a watch list here. I'm going to use I'll use my large cap watch list. It doesn't really matter what the watch list is. Actually, why don't we use something like, no, let's use the TMX watch list. So these are, fairly large cap stocks that are trading on the TMX. Now, in order to utilize the Options Play platform to find you short puts instantly, you want to use the income tab here on the right-hand side. You have a trading tab and an income tab. The income tab is going to be relevant for selling these types of shorter dated short puts and cover calls. Now, you have a toggle up here, and it'll ask you, do you own shares of Shopify? And you can either toggle yes for cover calls, or you can toggle no for cash secured puts. So that's what we're going to do here, is we're going to use no for cash secured puts. So what you can do is you can basically click on any symbol here on the left-hand side. Let's say you own 100 shares of BMO and you want to sell a cash, or sorry, let's say you want to purchase 100 shares of BMO and you want to figure out exactly what you should use. Well, using the income tab, just by clicking on the symbol, will actually show you what the expiration date and strike price you might want to choose. It gives you all of the yield return information here. So for example, you'll earn 1% yield in Bank of Montreal. That annualizes out to 16% over the year, and compare that to the dividend yield. If you own Bank of Montreal stock, you get about 4%, a little over 4%, nearly 5% dividend yield. But on the cash secured put, you're getting 16% yield annualized. So this gives you a sense for how much yield do you get on the stock, how much yield do you get on the cash secured put. Usually I like to see a very substantial premium in the cash secured put versus the stock itself to be worth taking on the risk. Now, banking stocks will have smaller yields than more volatile stocks like Shopify, right? So for example, if I pull up even some of the resource stocks, you'll see higher yield. Let's look at Canadian Natural Resources. As you can see, trading at nearly $78, this is telling me to sell the June $74 puts. This collects 2.52% or annualized out to 22%. Compare that to the 4% dividend yield. This clearly gives me a fairly nice boost to my portfolio in terms of yield if I want to choose and I want to take on the risk of potentially owning the stock at $74. If you just place a limit order at $74, you're getting paid no additional premium or capital to take on that risk. Here, you're getting paid, and that's really what makes purchasing stocks less risky, because you are collecting an income stream every single time you are trying to purchase that stock. And that income stream provides some downside protection on the purchase price of that underlying stock. And the goal of any stock purchase is to buy low. And this allows you to buy at a slightly lower price than if you were to place a limit order. Does that make sense, everyone? Please type 5 into the chat window if that makes sense to you. And you can just click on any symbol. You can either pull it up from your watch list, or you can just type it into the symbol lookup and simply go to the income tab, select no, and you'll see exactly which expiration date, what strike price, how much yield there is. As you can see here, you're getting about 16% yield compared to the 6.5% that Enbridge is already paying, which is very, very high. Yet the cash secured put is paying more than double that in terms of yield. So this just gives you a very good sense for where do you start, right? May 26th, $51 put. How much premium can you collect? How much yield is there? And that allows you to quickly make the decision as to whether this is a trading strategy that you want to pursue in your trading account. Okay, so let's go back to short put challenges. First challenge you're going to have is selecting stocks that meet your investment criteria to even purchase a put. And this is something that you really have to, in my opinion, look at some technicals and some fundamentals. Personally, I look at both. I have to see a stock that has reached a technical support level that is important, or the stock is oversold, which provides a better opportunity. Again, buy low, right? And the only way you can buy low is look for stocks that have sold off. So technically speaking, I look for stocks that are sold off, and I also look for, from a fundamental perspective, a reasonable valuation and a business that I believe in terms of future growth, right? It needs to have all three in order for me to take on the risk of buying that stock, because buying a stock, you're taking on a lot of risk. You should have as many of those things aligned as possible before you pull that trigger. The second thing you're going to have is managing short puts if the stock rises quickly and the maximum gain is generated, and determining what to do with that stock if it drops substantially. So those are the three different things, and we're going to talk about some of these scenarios here in the in this session. But before I do that, I do want to talk about a concept called rolling. I get a lot of questions about what is a roll, so I just want to address that before we talk about how do you manage a short put. A roll strategy is very simple. What you're doing is you're buying back an existing contract and you're selling a new contract, but you're doing it in a multi-leg trade in a single order, right? So you can do it as two separate trades. If you have a short put today, you can buy it back and then you can sell a new put, right? And technically that's still rolling it. But when we refer to a roll from a technical perspective, we're talking about buying it back and selling a new one in a single order so that you remove the execution risk where one side gets filled and the other side is still out there, right? So otherwise you kind of have to manage two separate orders, make sure one gets through first before you work on the other, or vice versa. So a multi-leg order that does both at once just basically removes the headache of managing two orders. You have one and you completely eliminate execution risk. If you don't currently have a broker that allows you to do this, I highly recommend that you take a look at some of the other brokers in Canada that does offer it. But there are, signs that brokers in Canada are moving towards offering multi-leg trading. So hopefully, there will be more support for this type of order type going forward in Canada. That is fairly common here in the US. So let's talk about the three different scenarios that you're going to come across. When you sell a short put, first thing that can happen is that stock effectively goes in the direction you expect it to and starts to rally. So this is really where it's good for your short put, but not good for your stock position, right? Because you want to buy low. You don't want to have to chase the stock higher. But if the stock goes higher, it's a good outcome for your short put, because the short put that you've sold is virtually worthless now, and you basically keep the profits or the income from that short put, which is why, I like to look for opportunities that have 20, 30% annualized yield on a short put, so that even if I miss out on the stock rally, I got a pretty nice income stream from it, even though I missed out on the stock rally. Right. So the rule of thumb is that if you can roll your short put for less than 25% of the original premium, then it's time to just take your profits and move on. Maybe you still want to chase the stock, maybe you don't. That's a decision you have to make at another time. But this is really one where rolling early, meaning as soon as the stock kind of takes off and you can buy it back for 25% of the original premium, it just allows you to generate yield even faster than you originally anticipated. But the thing that you really have to evaluate is if you thought the stock was cheap, but the stock has now rallied, do you still think it's cheap enough to sell another put and buy it again? Again, what you're doing is you're chasing a stock higher. I'm personally not a fan of chasing stocks higher. I like to try to buy as near the bottom as much as possible. Not always possible, but you don't have to chase stocks. So that's really probably the hardest part, in my opinion, is you miss out on a move, and you have to go out and find a new stock that you want to buy now because you have to find a new cheaper stock. Second scenario you come across is the stock trade sideways. This is really where you can hold the position and roll once you've made 75% of the max reward. So if you sold something for $1, it's now trading at 25 cents. You've made 75% of the total premium possible. You can roll that call, you can roll that put early and sell another maybe July $60 put, collect another $3. So what you're doing is you're just, again, accelerating the premiums that you're collecting into a shorter time frame than you originally anticipated. But for those of you that, I don't want to say, for those of you that don't trade as frequently, there's no harm in just holding these to expiration, letting them expire worthless, and then selling another call. The only thing, if you do that, is that you must remember to sell another short put. It's easy when short puts just roll off on their own, expiring worthless, that you forget the following Monday to sell a new cash secure put, which is why I prefer rolling it before expiration so that I have it done. I don't have to worry about forgetting about it. It's just done once I roll that position. And lastly, the last position that you've come across. And a lot of people, come to me where they say, I sold a short put, the stock declined. What do I do? And I always kind of say, there's nothing to do. What you wanted to happen happened, right? You wanted the stock to decline to the stock price that you wanted to purchase it at, and that happened. Now you own the stock. That's the best outcome. Now you own the stock at a cheap price, at a low valuation, and you got a discount on the stock purchase. But I guess there is the possibility that after you purchase the stock doesn't just drop to $60, it drops to $50, drop to $40, continues to drop, right? But here's the problem. Here's the thing, is that you have that same risk with any stock that you purchase. It has nothing to do with the short put. The short put is just the vehicle for which to acquire that stock. You were going to acquire that stock with the limit order. And if you acquire the stock with the limit order, you own the stock at $60 instead of $56. So you'd actually be risking $4 more if you had used the limit order. So whether you enter the order through a short put or a limit order doesn't really matter. The short put did what it was supposed to do. It got you into the stock that you wanted at the price that you wanted with the discount. So the thing that you do have to evaluate after you purchase any stock, doesn't matter whether you purchase it through a limit order or short put, is whether or not you want to continue holding onto the stock if the stock declines, right? That's a decision you have to make yourself. Now, for me, the reason that I like to buy low is that if the stock makes a lower low, I can pretty quickly determine whether it's time that it's for me to keep holding it. But if I buy high, then the stock has a lot further to drop before I'm saying, okay, maybe I'm wrong on this. I got to get out, and I'm typically taking a much larger loss. So the goal of a cash secure put is to build in the discipline of buying stocks low so that if you buy it at 56 and now it's trading at 50, okay, what I thought was going to happen if the stock rallying to $100 is not happening. I'll cut my losses at $50. I've only lost $6, right? I've risked $6 to potentially make $43 that I was talking about before. Those types of risk reward ratios works in my favor. So short puts, it's not going to protect you from a stock declining. Nothing protects you from a stock declining. Nothing protects you from a stock that declines that you were going to purchase, right? But that's the risk you take with purchasing a stock. No stock purchase protects you from doing that. So keep that in mind. But you do have to evaluate whether you want to continue owning that stock. If you do want to continue owning that stock, that's you want to go back to the lesson from 2 weeks ago, and you want to start selling cover calls. And this cycle repeats itself. And that's why the short put in the cover call is called the wheel strategy. You basically use the short put to acquire the stock. Once you acquire the stock, you start selling cover calls on it until it reaches your target price. Now you've sold your stock at your target price. You take the cash and you roll it back into a short put for the next stock. And you do this over and over again. It's called the wheel strategy because that's what you're doing. Because with every single stock, long-term stock investment, what are you doing? You're trying to buy low and selling high. And once you raise the cash from selling high, you want to roll it back to buying. So short puts and cash secured puts are basically your entry points on both sides that give you better entries and generates income streams on both sides. And when you combine the two strategies together, you have a very nice income generating strategy for your long-term investment portfolio. Does that make sense, everyone? Please type 6 into the chat window if that makes sense to you. Perfect. Okay. that covers what I wanted to share with you here today. Fairly short and sweet, really important mechanics. Like I said, the platform here is really designed to help you automate as much of this as possible. It's one thing to understand the mechanics of what I taught you. It's another thing to go in there and do it yourself. And our platform is designed to help make that process as simple as possible. You click on a single symbol, toggle it over to no, meaning you don't own the shares and you want to sell a cash secured put. It'll provide the expiration date, the strike price, the yield analysis, and it'll even it'll help explain it to you in plain English. So for those of you that are new to options, you're trying to figure out what the obligations mean, what risks you have, when do you own the stock, what are the probabilities of that? Our plain English sentence tries to demystify all of these technical terms into something that hopefully you can better understand. So there is a Q&A window and there's a chat window at the bottom of your screen. If you don't mind, pull up the Q&A window and type in any questions if you have any questions in there. How do you identify stocks which are going to be bullish in nature? Like I said, you got to look at a combination of technicals, fundamentals, and technicals and fundamentals for the most part, right? I'm looking at stocks that are oversold, stocks that have exhibited bearish trends, especially stocks that exhibited bearish trends. That's something I look for. And a lot of people say, why would you look at a bearish stock? Well, how do you buy low? You can only buy low on stocks that are in a bearish trend. If it's in a bullish trend, by definition, you're not buying low. You're buying high and hoping that it'll go higher. And the problem with buying high and hoping that it'll go higher is that the stock has to fall quite a bit before you're saying, oh, I'm wrong. And you're taking on a lot of risk, right? So I look for stocks that are bearish, that everyone's kind of looking away from, right? Certainly not looking as buying opportunities. I look at the valuations. I must believe the valuation is fair or below average. And then at the same time, I have to believe in the longer term perspectives of the business. I have to understand the sector. I have to understand the business, where it is relative to its peers. Those are all the things that I look for to identify stocks. How do you roll without losing on the trade? I'm not sure what you mean by that. Sometimes you do have to pay to roll. That's not always that you're capable of rolling without paying a debit. Is there a way to find the best risk reward to sell puts? I'm not sure what you necessarily mean by that. For one, there's no such thing as best risk reward. If there was best risk reward, everyone would be trading it. Risk reward is just a number, right? The higher the risk reward, the better in theory, but there's no such thing as best, right? But like I said, the best risk reward are stocks that are oversold, right? If I buy the stock here, it wouldn't have to go too much lower before I say, hey, you know what? I thought it was going to bounce. It didn't bounce. I'm going to cut my losses and move on. Especially if you compare it to the relative potential gain, if it does go in the direction that I expect it to. Here, I might be risking somewhere in the vicinity of $4 or $5, potentially make, in this particular case, $10. So my risk to reward is roughly 2 to 1 on that, right? That looks like a far more attractive buy. But if, let's say you waited to here, right? Let's say you waited for the bounce, you waited for the confirmation, you waited for the trends to turn bullish, and you bought here when the trends turned bullish. Well, guess what? Even if the stock reversed back to 92.5, I wouldn't necessarily know that I was wrong, right? Meaning it would really have to go below that, down to 90, before I would say, oh, okay, the previous support here that I thought was going to hold didn't hold. And now next thing I know, I've risked $8 to potentially make what, $4 or $5? That's a negative risk reward ratio, right? That's why when I hunt for stocks to buy, I don't look at stocks that have bullish trends. I specifically look for stocks that have bearish trends, because that's when you can buy low. If you look for stocks that are already in bullish trends, you are by definition already late to the trend. Can you make money? Absolutely. It's just harder, and you have to win more often in order to be profitable. It doesn't mean you can't be profitable. It's just harder to be profitable. What is the impact of dividends on the put? In theory, the stock price declines by the dividend amount on the ex-dividend date. It really depends on how big the dividend is. Usually dividends have relatively small impacts on puts. It can have, there are some stocks that pay very high dollar amount dividends, then that does have an impact on the stock price because you're effectively taking cash out of the company and the stock will decline by that amount. But that doesn't happen very often. Would you consider selling a put just for a trade if you don't necessarily want to hold the stock for a long term? You can, but that's a whole different strategy, right? You're just trying to maximize yield. You need to have a far better feel for direction if you're selling puts. If you don't want to acquire the stock, if you want to acquire the stock, you can basically sell a put at any time, right? Can you time it? Sure, but you can basically sell a put at any time, especially if the valuations you're compelled with, right? But if you're selling cash secured puts, or if you're selling puts just for the trade, then you have to time the market. So you can, it's just a different strategy than what we're discussing here today. How important is relative strength? It is important. I don't think it's the only deciding factor. I like to look for stocks that are oversold, that have relatively poor strength. And that basically means these are stocks that are beaten up. No one really likes them. I like stocks that no one likes because those are ones where you can really pick through some of the ones that have best bounce opportunities. It's not for everyone. It certainly is for some people, they believe it's higher risk. For me, I actually think it's lower risk, right? The lower valuation I purchase at, the lower price I purchase it at, the lower risk that I naturally take on it. And relative strength gives you a good sense for whether a stock is in favor or out of favor, and low relative strength stocks are out of favor. I have options play in my broker account. Are the suggestions from options the same as your platform? Yes. So if you have options play through your broker's platform, you have access to this platform and you're getting the same tools. With that, that covers what I have time for here today. I really appreciate you guys spending the time this afternoon. Hopefully this gives you a better understanding of how to utilize these short put strategies for your portfolio and how it can potentially benefit for you in the long run with regards to generating additional yield to acquire stocks. And once you acquire those stocks, to generate additional yield through those cover calls. With that, thank you so much. Have a great trading day, and we'll see you next week. Jessica will be teaching next week's session, so I'll be really looking forward to that as well. Have a great night, everyone.